I'm Jeremy Shepherd.
And I'm Damien.
We use data to expose deceitful property experts and their marketing BS. This is the Expert Busting series.
Since recording, negative gearing and capital gains are in a state of flux with the proposed changes from 1st of July 2027 and existing gains grandfathered. No laws yet have been passed. Speak with your accountant before acting.
Every few years I hear this sort of commentary from fake experts along the lines of adapt to the new phase in the cycle. Everything's different now. What worked before won't work again. And there's a couple of problems with this sort of commentary. If you're young, you need growth in your assets. If you're young, you can accept a higher risk because you have time to recover. Time covers over a multitude of ineptitude, so it'll fix your mistakes. If you're entering retirement, however, what you want is cash flow, something that replaces your 9-to-5 income. And so you're not so concerned about equity growth as you are when you're younger. So changes in your personal circumstances lead to changes in your strategy. But it's not changes in the market that trigger changes in your strategy and what you should be doing in your approach. That's not to say there are market changes that don't require some action. For example, I'm a big believer in selling once the market has peaked, move that equity elsewhere, pay capital gains tax, all that sort of stuff. You'll actually be better off according to the historical data. And also if the case arises where, say, a market has a rising vacancy rate, you might want to take some action there and contact your property manager and say, hey, can we negotiate a 2-year lease rather than a 1-year lease just to get through this period of higher vacancy rate? So the market can change and you have to react to it, but it shouldn't change your overall strategy, which is, maybe buy and hold, maybe it's a subdivision and sell or whatever your strategy is. It's not changes in the market that affect your strategy. So there's a problem with this where we hear it from these fake experts. By the way, even if you do sell, there must be a plan in place. You've had a plan in place. You're either going to draw down on equity after prices had grown, like at the peak of the market, or you were going to sell and buy elsewhere. So there was some strategy in place before you entered the market, which is either your exit strategy or what to do once you reach a peak. So why are they carrying on like this? Why do we get these fake experts talking about this change, that you've got to adapt to this new phase in the market?
Before we move forward, the strategy you discussed. So you've got an active approach versus a passive approach. Active, buying a property that's run down, has maybe potentially structural issues, cosmetic, you go in there, fix it up, add value that way.
Reno, yeah.
So the goal is if you can get that rising market plus reno, you add that value, that works. Or the passive approach, buying a strong market, set and forget, check in 2, 3, 4 years, go again. And that's more of the passive approach. But active, you might have options of townhouses down the track, maybe granny flats. That's being a bit more active.
Building on the block. Yeah,
building on the block. So that's more of an active approach. Most investors, I would say, are passive, right? Buy and hold. But as you discussed earlier or mentioned, that there is something in selling at the top of that growth cycle that with your property and then moving it to another market, right?
Yeah. So actually on that point, great point, Damo, thanks. If you intend to buy and hold for the long term, the longer you hold a property for, the more likely it is going to grow at the national growth rate. So there is a tendency for all properties, all streets, all suburbs, all cities around the country to grow at the same rate over the long term. Now, if you look at the last 30 years, there'll be outperformers and underperformers, but there is a tendency for them to grow at the same rate. So if your intention is to hold for the long term, your strategy is just time in the market, just sitting still. It's a less aggressive approach. It's very easy. You just accumulate until it's time to retire, and then you might sell down one or two. But if you want to outperform, if you want to get ahead, holding long-term isn't going to help you. You are going to have to trade property in order to get ahead of the market because of this phenomenon we see in historical data where there's this tendency to grow at the same rate. For more on that, the reason for it is there's an episode called Apples and Oranges. Look for that one.
On the EBS series.
The expert busting series, yeah.
So a common expert claim.
Yeah, so if everything really is different or what worked in the past won't work into the future, then nobody can look at the past and use it to know what will work now. And that includes the expert that made the comment. So it is purely an attention-grabbing headline. It's an attempt to claim expertise that isn't really there for a circumstance that isn't really there either. And these are the kind of statements that are often triggered whenever there is a change in, say, interest rates or a movement in the market generally, or a change in real estate laws or lending like APRA. Whatever has been in the news and is topical, they try to leverage from it, explaining they have the answers. It's just more marketing BS. And as soon as I see stuff like this, it immediately trips my BS alarm bell. And the second reason that they might say something like this is because, well, imagine there's an investment professional that only operates in a certain patch, a particular area of a city. This strikes a chord with you.
Let's just say it does.
I see you smirking.
Let's
there.
just say Maroubra as an example.
Oh, okay.
Or just any
You
suburb.
started with M there, and I thought you were going to say something else. Okay, good.
What did you
Maroubra.
think I was going to say?
Doesn't matter.
Okay.
Anyway, so imagine that patch has gone through a change recently. Perhaps the latest growth surge has come to an end. So rather than put their clients in the next growth location, which might be somewhere else in Australia, outside their patch, they put their new clients into the same area and simply manage their clients' expectations for growth. And there's more than one property market across Australia. All you need to do is change the focus of where you are investing. You don't need to change your strategy. Your strategy was always to seek out the best growth area for your budget. That does not need to change. What needs to change is where to buy. That's all. Staying put is not usually a good idea. By the way, it was episode number 12. I mentioned apples and oranges. Well, it's episode number 12, long-term growth, and episode 13, time in versus timing. Sorry, you were going to say something.
Back to this professionals patch, it does strike a chord because are investors really being put first? So I know you would debate this, wouldn't you, with a lot of professionals out there in the industry that jump up and down going, oh, I know the streets, I know the coffee shops, I know the area. Like that's what we hear a lot, right? They know the area because I've been operating here for the last 5, 10, 15 years. But the challenge is there's better markets. Like if you look at Australia as a whole, there's potentially a lot better markets, right? What they'll tend to do is, let's say they're buying just houses for their clients, and then the typical value starts getting too high, they'll pivot to townhouses or units because it is easier for them. Their profitability is a lot higher, and it's a lot harder to get set up in other locations.
Yeah, they've built up that relationship with local agents. And to be fair, they are experts in that area. If that's the only area they've been buying in for their clients for the last 10 years, they will know every agent in the area. They will know good value from bad.
And they'll know the streets too. They'll know they will know different things that but I still think of it as from a suburb aspect. At the end of the day, they might know that street, but I might go by on a busy road in another market and it's done 50% a lot better the last 3 years. So I don't need to know the market. Like, yeah, I can get a plane there, drive there, but for me, it's all about that capital growth, especially through the accumulation phase. So I just get frustrated when I hear this is the way that it is. You need to use us because we know the market, we know our area. That's their opinion, and they're entitled to that. But when you say something is fact when it's actually not, that's when I get frustrated.
Yeah, and on that whole thing about buying well, that's what they would do because they know the area well. I'd rather buy poorly, pay 5% above market value in a hot market which delivers 50% over the next few years, rather than buy 5% under market value and get 0% capital growth over the same period of time.
Blue chip, that's the one we always hear, isn't it?
Blue chip, yeah. All right, so time for some data. If you go to the next slide. Yeah, so this chart helps to highlight one of my points here. So this chart shows the 5 big state capitals, so Melbourne, Brisbane, Sydney, Perth and Adelaide. And it shows when they have been in boom conditions. Now, by boom, I've defined it as 10% per annum growth or higher. So this is an all or nothing sort of binary chart. Either the city is in a boom or it isn't. And the period on the chart covers the last 30 years. So that's from late 1995 to late 2025. We're actually recording this in early 2026. And as you can see, there are times when one city might be booming while another is not. For example, Melbourne and Sydney in the late 90s, that's towards the top left of the chart. Note that the size of the boom is not shown. So it looks like from this chart, the Melbourne, the top there, would have been the best city to own in because more of its time is in boom conditions. But some of the other markets might have had bigger booms. Well, they did have bigger booms. That's when measured by total growth. So this is not a measurement of growth. It's just time when it's worthwhile to own a property in these cities. So you'll see there are 2 nationwide booms on the chart. The first was soon after the turn of the century in the early 2000s. You can see a boom in all 5 of these markets for that period of time. And the second nationwide boom is on the right side of the chart, and that was the COVID-fueled low interest rate period from 2020. And if you look closely, you can see gaps when none of these cities were booming. Right at the start, for example, there's a gap from 2005 to 2007, another one from 2011 to 2014, and one more from 2018 to 2020.
Well, Brisbane, Perth, Adelaide were almost in sync, weren't they? If you look from 2009 to 2020, pretty much no growth, and then all of them pretty much moved after that, right? After 2021.
Yeah, and keep in mind that there can be areas of a city that are booming while the city as a whole is not. For example, at the time we're recording this, there are parts of Melbourne that are booming, but the entire city is not. So, yeah, if we looked at the suburb level instead of the city level, there would be even fewer gaps than what you're seeing here. Well, there would be no gaps. And also this chart doesn't consider the other 3 state capitals, as well as the major regional cities like Newcastle, Wollongong, Sunshine Coast, Gold Coast, etc. So all this chart is all this chart is doing is it's identifying when it would be a good time to be an owner of a property in each of these cities. And for most cities, you can see that for most of the time, it's not been a good time to own. Only very short periods over the long term have been good periods to be an owner. However, there are very few times over the last 30 years when it has not been a good time to be a property owner somewhere. So the idea of this chart is to point out there's never a bad time to invest if you know where to invest. And that means there's no need to lower your expectations. When a market that you've bought in starts to level out, it's time to look elsewhere. All right, the next slide, please, Damo. Thanks. If you notice that demand and supply are starting to balance out in a market that you've bought into, you've got these 3 options, right? Number 1, you can sell. Number 2, you can refinance. Or number 3, you can simply sit tight and wait for the next growth spurt. Now, if you sell, you will need to reallocate the sale proceeds to a better place. And there are costs involved. So the biggest is capital gains tax. Plus you have to pay a selling agent a commission, typically 2% of the value of the property. And then when you re-enter the market with those sale proceeds, you've got to buy a replacement property, and that means you have to pay stamp duty,
And
say
a buyer's
4%.
agent.
Maybe a buyer's agent. Maybe you like to buy some cool data too to help pick that location. Now, if you bought in your own name, roughly 20% of the gains your property made is going to be lost to CGT. But the remaining 80% is yours, so you get to keep most of it. And that estimate varies a lot depending on all sorts of variables, your own specific circumstance, how long you owned the property for. So that's very rough, it's 20%. So the replacement property needs to grow by comfortably more than that, say 30% over the next, say, 3 years, for that to make sense, trading the property, selling, incurring that cost, those reallocation of equity costs, buying elsewhere, you're weighing that up against the opportunity cost. So you would need a 30% growth difference between the two markets. So if one market goes flat, the other has 30% growth, all right, that's good enough to trade.
If you're unsure, you can head over to suburbdata.com.au and reach out to us, and we can do that analysis for you. If you're not sure, hey, I've got an underperforming property, I don't know if I should reallocate my funds, that's something that we can provide advice on, which we have done in the past.
Yeah, it's called our should I sell analysis. So ask for the should I sell analysis. All right, option 2 is refinancing. So it's a little easier to do than the sell and buy elsewhere, but it simply might not be as efficient. And that's because you'll be hanging on to a potentially underperforming property. That market may recover sometime into the future, but you don't know how long that's going to take, and it might not boom again for a very long time. Also, you may have reached your serviceability limits, so you might not be able to draw down against that equity. You might actually have to sell to free up that equity.
And that's where people, I think a lot of investors get caught out, right? They've got this property and they're capped out, right? So they've either got two options. They just hold it, take a long-term view, forget about it, or they be a bit more active, sell down, and then reallocate those funds to another asset or another area, really, and get that capital growth. So that's again, it is a bit more of a riskier approach potentially because of the...
You have to get a lot right.
You have to get a lot right, but we're confident in the data, aren't we?
Yeah. It's I do this should I sell analysis regularly on my properties, not ones that I've just bought, but stuff that I've had for at least 2 years. And there's one property, it's the first property I ever bought, always comes up with a no. Should I sell? No. And the reason, because I've had it for over 20 years, there's just too much capital gains tax to pay. So it's a case-by-case scenario. Okay, so the third option is to do nothing. You simply wait. If you wait, you have the same problem with future performance as with option 2, the refinancing, in that you might be hanging on to an underperforming asset for a longer period of time than you expected. But at least your serviceability limits will eventually be resolved because the rent rises. But anyway, there's nothing radical about these options. You've probably heard all of this sort of stuff before. Nothing radically different in any phase of any market. These have always been the options available to investors. So there's no reason to adapt to this new phase. The options that are available to investors when markets peak and the surge and slough nature of capital growth, those price movements, nothing has changed. There's nothing different. It's just what you do now is responding to the market. You're not actually changing your strategy. All right, so if your strategy is to pursue growth, then pursue it anywhere within the country. There's bound to be a market that's about to enter its next boom phase. Steer clear of the old school buyers agents who always invest in the same suburbs year in, year out, and they manage the expectations of their clients with this sort of marketing fluff. And also bear in mind that the longer you hold a property for, the more likely you are going to get average sort of returns. You're not going to be able to get ahead of the rest of the market unless you trade property. Unfortunately, it's much easier to do that now. We've got research tools and data that was not available in the past. So the advice of the old school buyers agents, buy and hold, never sell, that was actually good advice in years gone by. Now in the data age where we can forecast capital growth a little more accurately, it's dated advice. So the better advice is look at your situation, see if it is worthwhile selling and buying elsewhere. That's all I got on my notes. Damo, did you have anything to add?
No, I think you hit all those points correctly. I think the other one is just really think about how fast you want to build your wealth. I've seen clients in the past where I vividly remember a long time ago, I had a client, he had 3 properties back in Perth. And look, Perth has done great at the time of recording in 2026, but there was a period there we had them for like 4 or 5 years, and he had 3 all allocated in the one area, and they pretty much did nothing, if not went backwards a little bit. And he goes, I thought these properties are supposed to double in, sort of 7 years' time. And that's a perfect example of just being leveraged very heavily in one spot. Look, that can work in a growing market like Perth at the moment, or the last 3-4 years. You'd be laughing if you kept all those properties. So it's just a bit about look at your circumstances, target areas with high DSR scores, and then if you're not sure, reach out to us. We're here to help. So next up in the Expert Busting series is episode 23, Saving for a Deposit, Why It Holds You Back. Thanks for watching.